In fact, I think it ended up at 52% voting to Brexit and 48 voting to remain part of the EU. Now, of course, the markets were taken completely by surprise. In fact, we had rallies into the close on Thursday as everybody was so confident that the polls would be right and the online casinos would be right, and that it was pretty much a sure thing that the British were going to vote to remain. After all of the experts, all of the economists and the political elite and everybody all around the world, including President Obama, had lectured the British as to why the smart thing is to stay in the EU and how dangerous it would be, how awful it would be, how it would be like the second coming of the Antichrist, economic Armageddon, if they voted to leave. And of course, maybe this was a little bit of a reverse psychology. Maybe had they urged the Brits to vote to leave, they would have gone remain. I mean, sometimes you want to just do the opposite of what you're being encouraged to do, especially when you've been lied to so many times and you've been sold so many bills of goods over and over again. When the same people tell you, trust us, we know what's right for you, and you need to stay in the EU, because a lot of people in Britain were made a lot of empty promises, and a lot of people over there are experiencing the same type of problems that we're experiencing on this side of the pond. They have a falling standard of living, they have a rising cost of living, and people are getting more and more desperate. And here we're reaching for straws like Donald Trump or Bernie Sanders. And the straw that they had was Brexit, leaving the EU. And that is what they voted to do. Now, I think the markets, of course, are way overreacting to what the implications are for Europe exiting the EU. After all, think about all the countries that aren't in the EU, right? I mean, if it's so terrible to not be in the EU, why aren't we all members, right? Why doesn't the United States join? Look, they can't even get Switzerland to join the EU, and it's right there smack in the middle of Europe. In fact, one of the reasons that Switzerland is probably the most prosperous country in Europe is because it had the good sense not to get into the EU and not to adopt the euro as its currency, although it's de facto kind of adopted it through intervention. But I think what happened is the markets believe their own hype. For so long, we were talking about how awful it would be if the British actually voted to leave, that when they did vote to leave, it was a self-fulfilling prophecy. Because, look, everybody is a short-term trader, right? They're all in this for the quick trade. A lot of these guys are all levered up. And so the minute this event happened, everybody hit the same sell button, right? Everybody had the risk-on trade, right? The risk-on, things are good, we're not going to Brexit, so it was a false alarm, buy stocks, you'll make money. People borrowed money, they levered up, they got long. Everybody was prepared for a remain vote to carry the day, and instead, we got the leave vote, and so everybody had to hit the sell button at the same time. That's really what happened. It's not that this is such a bad event economically that everything is collapsing. All this is reflecting is traders having to reverse their bets. If you look at what happened in the flight to safety, right? Because the dollar was way up, but not just against the pound. And the pound really got pounded. It had its biggest down day in the history of the pound. It was down about 8%, 8.5%. But at one point last night, I saw it down better than 10%. And of course, the pound was pounded even harder relative to gold, right? The price of gold in terms of British pounds rose above 1,000 pounds per ounce last night when it was up about $100 an ounce, briefly, right? Gold went up $100 an ounce. It was over $13.50. In fact, when it did that, I tweeted it out, and that was pretty much the top, because by the time I finished the tweet, it was already 20 bucks off that high. But I thought it was a significant thing that that gold had managed to spike as high as $100 an ounce. So pound finished the day down about 12 or 13% against gold, because gold was up 5%. Gold was the strongest monetary asset of the day, but number two was the yen. And the yen, at one point I saw the yen up about 5% last night against the dollar, which meant it was up like 15% against the pound. Now, why is everybody buying the yen? Why are they buying the dollar? Now, people say, oh, it's a safe haven. Not really. I mean, does anybody think that the Japanese economy is some bastion of safety? I mean, come on. I mean, there's a lot of problems in the Japanese economy. And there's even more problems in the American economy. I mean, why would anybody worried about Europe buy the dollar? I mean, yes, UK is going to leave the Eurozone, but America isn't even in the Eurozone. I mean, if it's so bad not to be in the Eurozone, why are you buying the dollar? And again, the Swiss franc, the Swiss government had to intervene. I mean, they didn't have to. I mean, they were dumb, but they did it. And the Swiss franc was down only about 1% or so against the US dollar today. It probably would have been up had the Swiss central bank not intervened. But think about the irony of this. People are so worried about Britain leaving the Eurozone that they're selling the euro to buy the Swiss franc, which is a country that never even entered the Eurozone. So think about the irony there. But what is going on here? It's not about safety. It's about risk on and risk off. What is risk on? That is when you buy risky assets like stocks. Doesn't matter, any kind of stocks, right? You just buy stocks because they're going to go up. And how does the leveraged speculative community fund the risk on trade? They go to the funding currencies. The currencies where you can borrow real cheap. The most popular funding currency is the Japanese yen, right? Everybody wants to borrow in yen because, they pay you to borrow in yen. So it's real cheap. You can lever up. And to a lesser extent, the dollar is a funding currency. I mean, we've had very, very low interest rates in the U.S., especially when you look at it relative to our inflation rate. So there are a lot of people that borrow yen, borrow dollars, and lever up. They buy all kinds of stocks, right, all over the world. That's what everybody was doing going into the Brexit vote because everybody was looking to ride the Remain to new highs in the risky assets. And so the minute everybody was shocked by the results, people had to reverse the risk on trade and they had to put on the risk off trade. Well, how do you take off risk? Well, you sell the stuff you bought, right? And you buy back what you sold. So you sell the stocks that you bought and you buy back the yen or the dollars that you shorted. And that's what happened. That's why you had these big spikes in these currencies. It's not that people are saying, oh, Japan is such a safe country, I want to be in the yen. They're not even thinking. They're just acting. It's just a reflex. The same thing with the dollar. There is no safety in the US dollar, but people are buying it anyway. But the only asset that is actual safety was gold because nobody is funding their risk on trades by shorting gold. At least I don't think they are. I mean, that'd be a pretty dumb way to do it. But everybody bought gold because gold went up in every single currency on the planet. But a better way to look at it is not that gold went up. It's that every fiat currency went down. It's just that some went down more than others. So the fiat currency that lost the least value was the yen. And then after the yen, the dollar. And then after the dollar, maybe the Swiss franc. And then, the Canadian dollar didn't do that bad. But it was still down, I think, over 1.5%. But the point is, gold didn't go up. Everything else went down. And I think this is, again, a breakout in the price of gold. We did close up about $60. So we never regained the $100 up level that we achieved, right after it was obvious that Remain was going to lose and that Leave was going to win. But we closed above 1315. This was where all the resistance has been in gold. Every time we got above 1300, we got clobbered. We never closed above it until today. And I think this is a good breakout in the price of gold. And I think we're going to see a lot more upside in the days and weeks ahead. In fact, even Goldman Sachs, I think Curry was out there, who had been very, very bearish on gold all the way up, is now getting bullish. I don't think that that's necessarily a contrarian indicator because it's not like everybody is bullish. And he's not wildly bullish. He's just kind of mildly bullish. And a lot of the reasons for the bullishness is the uncertainty surrounding the Brexit. This has got nothing to do with it. A lot of people think the reason that gold is up is because of Brexit. I mean, that was the catalyst for the rally today, but it was going up anyway. In fact, the reason gold sold off over the past couple of weeks is because people were pretty sure that Brexit wasn't going to happen. And so people started selling gold because everybody thought, well, Brexit is good for gold, and since it's not going to happen, that's going to be bad for gold. I always said it was noise. I think even if they had voted Remain, I believe gold would have gone up. So I don't think it mattered. But this is an easy excuse for the people who don't understand why gold is going up. They can just chalk it up to the uncertainty. and not look at all the things that we're actually certain of in the U.S. economy and with the Fed and the dollar that are the real driving force behind gold. And in fact, you didn't get a lot of people jumping on board, because if you look at the gold stocks, the GDX was up about 6% today on a 5% move up in the price of gold. I mean, normally you get a 5% move up in the price of gold. You'd probably get a 10 or 15% move in the price of gold stocks. I mean, not normally, because you don't normally get a 5% up move in the price of gold in one day. This is one of the biggest up days in the history of gold, percentage-wise, but not really for gold stocks. We've had plenty of days this year where gold stocks were up more than they were today, even though the price of gold wasn't up as much. So I still don't see a widespread embrace of the gold trade by the Wall Street crowd. So I think this is going to continue. In fact, I mentioned on an earlier podcast the big difference between gold and the financials, because the financials are getting decimated. I mean, some of these banks, Barclays was down better than 20%, the British bank, but you had Credit Suisse, I think, was down 15%, a Deutsche Bank down 16%. These are all new multi-year lows. I don't even know how long it's been. These are way below the Lehman lows of 2008. So as the financials are getting crushed, the antithesis of the financials, gold, is going higher and higher. And I think this trend is going to continue. And I have no idea how long it's going to be before Wall Street kind of jumps onto this trade. But so far, the fact that so few on Wall Street are buying into it, I think is a good thing, because we continue to climb this wall of worry. And the less baggage we have, the more I like it. And in fact, there was even more economic news that came out today that was ignored, because obviously the Brexit headlines trumped everything. But we got durable goods orders that came out for May, and they were bad. I mean, they're pretty horrible. They were looking for minus 0.7, and instead we got minus 2.2, about triple the decline they were looking for. And they even slightly revised last month's spike from 3.4 to 3.3, but the internals were even worse. In fact, core capital goods year over year down 3.6%. They revised last month's decline to down 4.2 from 5, but still that's 17 consecutive year-over-year declines in core capital goods. I mean, 17 months in a row. This has never happened in the U.S. economy unless the U.S. economy was in a recession. And I still think it hasn't happened outside of a recession, because I think we're in one. It's just that nobody wants to admit that we're in one. Even the consumer sentiment index that came out today came out worse than expected. Last month was 94.3. They were expecting a slight decline to 94. Instead, we got to drop down to 93.5. And I'm sure what's happened this month and what's happening in the markets is going to cause that number to go a lot lower. Now, also today, the Atlanta Fed, which has this crazy second quarter GDP estimate of 2.8, right? They went down to 2.6 as a result of, I'm not even sure, but they came down to 2.6. But to me, that still looks like it's awfully high for an estimate for second quarter GDP, given all that is going on in the second quarter. But I think the person who was likely to be the happiest today was Janet Yellen. I mean, as far as Janet Yellen is concerned, this is manna from heaven. I mean, this is just what the doctor ordered, right? Because Janet Yellen has been in a bit of a quandary, because she's been talking about how great the economy is, but she hasn't been raising rates. Yet she's been saying that higher rates are appropriate given the recovery, yet she won't raise rates. Why? Well, because I think she knows that there is no recovery. It's just a bubble. And she doesn't want to put any more holes in it by raising rates again. I mean, she tried that once and it was a disaster. And maybe that's the one time the Fed has actually learned from its mistakes. Again, not that it was a mistake to raise rates. The mistake was thinking you can get away with it, which the Fed couldn't do. So obviously they don't want to do it again, but they don't want to admit that. So they keep talking about how the economy is recovering and we're on this road to recovery and there's a rate hike around the next corner. We just don't know where that corner is or how long it is, but don't worry, we're coming there and we're going to raise it. But now she's got an excuse. Right, all hell's breaking loose now. The markets are tanking. The dollar went up. There's all this uncertainty now. Is Britain headed for recession? What about Europe? Is that going to spill over into the U.S.? They can talk about, this strong dollar. Not that it's going to last very long, but they'll say, this is going to mean there's not going to be a lot of inflation. Ironically, one of the things I keep hearing people talk about on the news today was how Britain is going to benefit from this big drop in the British pound. Like, hey, they got lucky here. See, the pound got clobbered. This is going to help the economy. It's not going to help their economy. It's going to hurt the economy. The reason the pound got pounded is because people believe that Brexit is so bad for the UK. Now, I don't think it is. I think it's good for the UK. But a lot of it depends on what the UK does. See, if this really is a repudiation of big government, of excess regulation and bureaucrats meddling and micromanaging, then it's good for Britain. But they have to bring it home, right? It's not say, hey, let's get out from under the tyranny of Brussels. They don't want to replace it with their own tyranny, homegrown style, out of London. What they've got to do is they've got to take that limited government, less regulation, more freedom. They got to take that to heart and incorporate those changes internally. See, a lot of people were using Switzerland as an example of how successful you can be outside the EU. Yes, but you got to emulate Switzerland in other ways. You got to, take apart the welfare state and have, smaller government, have lower taxes. And the British can have all that if they're smart enough to vote for it. And in which case, the pound is a great buy relative to other fiat currencies. But the fact that the pound is down is not a relief. It's not going to make things better in Britain. It's never better when your citizens are poor. It's never better when your cost of living goes up. That's the nonsense that passes for genuine economics. That's the stuff that they were trying to shovel down the throats of the British to get them to remain in the EU. But bringing it back here to Janet Yellen. So now she's got this perfect excuse, a perfect scapegoat why she doesn't have to raise rates. See, it's not because of the U.S. economy. See, the U.S. economy was great. And, we were getting ready to raise rates. We were just about to do it. And then all of a sudden, this Brexit thing happened. And, now we can't do what we were going to do. Yeah, we've got a really strong economy. But, now there's some uncertainty out there. We got to be careful about some of this stuff spilling over from Europe and infecting our otherwise healthy economy. Maybe this is kind of like a little virus. It's like a flu, and we want to make sure we don't catch it. Kind of like the Zika virus, and so we just need to be a little bit careful here. And in fact, maybe we need to inoculate ourselves against this disease. And you know what that means? They got to cut rates back down to zero, right? Maybe we have to do QE4, not because the U.S. economy is sick, but because the rest of the world or Europe is so unhealthy that we just need to inoculate ourselves to make sure we don't catch that, right? Because our economy is in good shape, but we just need a booster shot of this stimulus. And don't worry, at some point in the future, we'll turn it off. We'll raise rates back up. We'll shrink the balance sheet. We're just going to have to do it a little later than we thought. See, this is perfect. And even if they have to do this before the election, it doesn't make Obama look bad. And by extension, it doesn't make his heir apparent, Hillary Clinton, look bad, because if the Fed has to ease because of problems in Europe, hey, it's not our fault. Hey, after all, Obama went to Europe and he warned the Brits not to vote for Brexit, and they did it anyway. And so, it's not his fault. And of course, the Fed has just got to do what a central bank has got to do. It's got to, provide liquidity. Also, I was watching on CNBC, and Alan Greenspan was being interviewed. And they asked him about this, and he was like, this is the worst crisis I've ever seen in his career. I mean, what is he talking about? And then he said, this is even worse than the 1987 stock market crash when the Dow was down, 20% in one day. I mean, what was it down? 3-4% today? I mean, Dow was down 610 points. How is this worse than the 87 crash? What is this guy talking about? And how is it worse than the financial crisis in 2008 when the U.S. economy was imploding? Where is this guy coming off saying this is the worst thing he's ever seen? I mean, maybe because he's not the Fed chairman. He wants to make it look like, look, this is way worse than anything that happened on my watch. Although I would still, saddle him for what happened on Bernanke's watch, because he's the guy that lit that fire. Sure, Bernanke, didn't put it out. He made it bigger. But Alan Greenspan is the guy that got it started. But, then he started talking about entitlements. And, the problem is entitlements. He's been saying that since the beginning. If you look, I finally found the emails that Alan Greenspan sent to me back in 1987. I emailed him, not emails, letters. We didn't even have email back in 87. What am I talking about? So, when I got out of college and we had the financial crisis and the stock market crash, and I saw what Greenspan was doing, right, in response, I knew he was doing the wrong thing. How did I know? Because I read what Greenspan had criticized the Fed for doing in 1929 And I said, guys, he's doing the exact same thing. Why is he doing exactly what he said you're not supposed to do? So I called him out on him. I sent him a letter. And he replied. He sent me a letter. And then I followed up with another letter. And he sent me a second letter. And I put those two letters on the internet. You can see it on the Schiff Radio website, schiffradio.com. Check out the letters he wrote me. But back then, what did he say? Congress just needs to get the budget under control. We need to get entitlement spending under control. Well, he's still singing that song. I mean, what is this, 30 years later? I mean, doesn't he know by now that that's not going to happen? And, then he said, well, we just need to slow down the growth of entitlements. It's not about slowing down the growth. They're already too big. How can they grow? I mean, we've got to get rid of these so-called entitlements, but we can't do it. So all we're going to do is keep on growing the debt until we have a crisis. And maybe Greenspan knows that there is a big crisis coming. And what happened with the Brexit is the wake-up call. See, what he's really worried about is not what happened on that side of the Atlantic, but what this guy knows is going to happen on this side of the Atlantic. Because this is the real problem. We don't have to worry about what's going on in Europe. We need to worry about what's going to go on over here. And, from a political perspective, the fact that the Europeans voted, right, to leave, right, this raises the odds that they're going to vote for something similar in the U.S. And what's similar to that is Donald Trump, right? It's not Hillary Clinton. Voting for Hillary Clinton is like voting Remain. It's like the status quo. I'm happy. I don't want anything to change. Well, why would you be happy with this disaster? And if the only change that you can vote for is Donald Trump, well, then that's what you're going to do. Even if you don't like him, you'll hold your nose and vote for him anyway. Now, it was interesting. I looked at a poll that on the Sanders voters, apparently almost half of the Sanders voters aren't going to vote for Clinton. And about maybe 20% of them said they would vote for Trump. And I was surprised. About 17% said they would vote for Gary Johnson, the Libertarian candidate. I'm surprised they even know who Gary Johnson is. Maybe he was just on the poll and they saw the name and they said, yeah, I'll vote for him because he's not Hillary and he's not Trump. So this probably raises the odds of that. But we are coming to our own crisis, our own version of Brexit. And it's unfortunate, too, that we don't have on the ballot, in all the states to get out of the United States. I mean, why can't we do a Texit, right? Which would be Texas voting its way out. Or any country. I mean, a lot of these countries that don't have their own income tax and are net taxpayers to the U.S. government would like to vote to get out from this union. I mean, you talk about all the bureaucrats and all the regulations coming out of the EU. Well, we've got it in spades coming out of D.C. That's our EU, right? That's our bastion of bureaucrats. I mean, a lot of these guys aren't elected. A lot of these guys are just appointed bureaucrats that are just, micromanaging us and ruling over us as they live in their, little ivory fishbowl of Washington, D.C. If you didn't see that video, I put it up on my Facebook page, Brexit the Movie. I really recommend checking that out. It really does a good job of showing you the culture that they've created over there in Brussels with all these bureaucrats. And, this is kind of one of the reasons, too. You have so many people in poverty, and you juxtapose that to these guys living high on the hog, in Brussels, working for the EU, while ordinary Britons are barely, putting food on the table. This is what's going on. And they're asking people to get by with these little trinkets of freebies that they give you, kind of Roman style, bread and circus. Hey, just, be satisfied with this and don't care about what, us Romans are doing here in the palace. Just be happy that you're getting, your free stuff. And well, eventually they throw that free stuff right back at you. And I think that's what's coming on. We've got our own political revolution coming in the United States. I have no idea what's lurking on the other side of it, just like we really don't know for sure what's on the other side of this Brexit. Are the British going to vote to make themselves the next Switzerland, or are they going to vote to make themselves the next Greece? I don't know, right? But, if you look at that or watch that movie on, Brexit the Movie, they do a good job of comparing what happened in the UK after the Second World War and what happened in Germany. Because Britain won the war, but their people lost. Germany lost the war, but their people won. Because when Germany was dismantled, so was their government. Right? And so they rose from the ashes of defeat with free market capitalism. The British government survived the war, unfortunately for the British, and it got bigger and bigger. And they got even more control and more regulation and more taxes. And so within a short period of time, after the war was over, they were actually rationing consumer goods in Great Britain, and they had massive abundance in Germany. And so while the UK was riddled with inflation, the Germans benefited from deflation. Yes, they had inflation after the First World War, but after the Second World War, when they had a freer market approach, they had deflation, they had falling prices, they had abundance, they had all the consumer goods they wanted. They called the German miracle. There was nothing miraculous about it. It was just freedom. It was just capitalism. You know, the crazy thing is the countries that lost the war, look at Japan until they screwed themselves up with Keynesian economics after the 1980s. But the other country that lost the war, Japan. I mean, Japan just rose like a phoenix from the ashes. I mean, we had bombs. Japan was a wasteland. I mean, yes, there were bombs that landed in Britain, but Britain was in great shape compared to Japan and Germany. And yes, you know, Japan and Germany got money from the United States in the Marshall Plan, but we gave more money to Britain. Britain got more money than Germany or Japan. The problem was Britain's government was intact, and in Japan and Germany, the governments were in ruins. And they started from scratch, and they followed a free market plan, and that's why they became so successful. So there is a blueprint that works that the British can follow. In fact, Britain ruled Hong Kong for a long time. And look what a success Hong Kong was. I mean, Britain was a basket case for all the years that Hong Kong was booming. Why? Because they left Hong Kong alone. They didn't subject Hong Kong to all the crazy regulations and taxes that they inflicted on their own people. So hopefully they'll make the right choices. But again, in the United States, I don't know what's on the other side of this revolution that's coming, or this political evolution, but it's coming. And we're about to hit a brick wall when it comes to deficits and entitlements and the Federal Reserve. And that is going to make what's happening over there in Britain, right, look like that proverbial Sunday school picnic. And that's what I think Alan Greenspan is talking about. He can't possibly be talking about what just happened last night as the worst thing he's ever seen. He must know that this is the first domino, and there's a lot of dominoes coming down that really have nothing to do with Brexit. But this is just basically the tipping point. And now a lot of things are going to happen that people didn't expect. And a lot of those things are going to happen in the United States. And I believe that Alan Greenspan knows this, because for all the mistakes he made and all the stuff he got wrong, in his heart, he's still an Austrian. He still believes in the gold standard. I mean, you don't get as smart as Alan Greenspan was. And you read some of his early writings. He was a smart guy. You know, when he was hanging around with Ayn Rand, I mean, you know, he wasn't a fool like some of these other central bankers like Yellen or Ben Bernanke. This guy knows his stuff. And for whatever reason, he went over to the dark side, you know, kind of like Darth Vader. But, you know, he has one foot, you know, on the good side, you know, and so he understands this. And so he knows that something really bad is in store for us, because he understands the mistakes that he made. He understands the mistakes that Bernanke made, and he understands the mistakes that Yellen is making. He just doesn't want to admit it, because then he has to basically, you know, condemn himself. He has to fess up to his own sins. He doesn't want to do that, at least publicly. But you read between the lines, and the fact that he sees this disaster coming. He knows it goes much, much deeper than what's going on in Britain. And he knows it because he was in the thick of it, at the heart of it. And now he wants to create a little bit of a distance from himself. He wants to be able to say, oh, I warned you about it, like I saw it coming. He doesn't want to, you know, be as blind as he was before when he said, oh, there's no tech bubble, or you never know a bubble until after it pops, right? He wants to have a little bit of vindication. It would just be nice if he fessed up. Maybe, who knows, maybe before he dies, he'll have a guilty conscience and he'll want to do something, you know, good for a change, and just acknowledge, you know, just kind of, you know, just take one for the free market team and just kind of confess your sins, right? Just admit all the mistakes that you made, so maybe we won't make them again in the future.
Today's financial advisors behave like pro wrestling TV commentators. They scream that the recovery is strong, debt is manageable, inflation is low, and that the Federal Reserve has everything under control. They may be oblivious, but the danger is real. Looking beyond the media hype can open a world of broader investing ideas. Euro Pacific Capital is a registered investment advisor that offers stock-focused wealth management services that closely follow the strategy of our founder and CEO, Peter Schiff.
Silver prices continue to march higher Gold was up another $7 today. It closed at 1363.20. That is the high for the year. Silver is now above $20 an ounce. It was up 15 cents at $20.06. You know, on Sunday night, before the 4th of July holiday here, silver prices actually got above 21. They got up to about 21.30 or 40 or something like that before there was some profit taking. But we still are making significant progress on the year. Not only silver prices going up, but the silver price going up now relative to the price of gold, which I think is very bullish for the precious metals complex. You know, gold stocks are on fire. The XAU index, which is a gold stock index, was up 3.27% today. It's now up better than 135% on the year, and more than that. I mean, well over 150% from the lows on the third week of January. But do you think anybody on Wall Street, any major players, any major investment houses have recommended that anybody buy gold stocks? You think any of the big hedge funds have any positions in gold stocks? No, they are clueless. You know, what is happening right now, and I've said this before, is that you've got this picture that's kind of blurry, but it's coming into focus, but it's still not yet clear, and it's a game changer. Because the image in everybody's mind up until now, or it's still in their mind, was that we had this great recovery, or at least a recovery, and that the Fed was going to be able to unwind its balance sheet, normalize interest rates, and everything was going to be great. So the whole investment world was preparing for higher rates and a stronger dollar and a stronger U.S. economy. But what is the world that we actually are living in? What is the actual picture rather than the one that they fantasized? The actual picture is an economic recovery that is actually already over, if it ever existed, that the Fed is finished tightening and they're about to start a new easing campaign, that we're not done with QE, we're just getting started. QE3 is closer to the beginning than the end. We're about to do QE4. We may even go to negative interest rates. And rather than shrinking the balance sheet, it's about to explode. It's going to go much, much higher. And so this picture is beginning to, come into clarity. And now you're starting to see the markets repricing, where gold is going up every day. Gold stocks going up. The banks are getting crushed. The European banks, again, today, new lows on the year, new lows on the decade. They're getting crushed. And people are now starting to realize this. The Federal Reserve today, the FOMC minutes came out for June. And what did the minutes reveal? Oh, what a shocker. That the members were concerned about the weakening employment numbers and that they wanted more data before raising rates. They wanted to make sure that the weakening numbers were an aberration and rather than the beginning of a new trend. Well, who didn't see that coming? Also, they said that they wanted to wait and see what happened with the Brexit vote, right? They thought it made sense not to raise rates before the Brexit vote. Let's just wait until they receive the results. Well, the Brexit vote was something that we knew about all year. Earlier in the year, in March and April, when everybody was so convinced that the Fed was going to raise rates in June, we all knew that that was a couple of weeks before the Brexit vote. Yet people assumed that they were going to do it anyway. But now the Fed admits, well, we don't want to raise rates until we know the results of Brexit. Well, then why were they pretending for so long that they were going to raise rates in June? Why did they allow the market to believe that a rate hike was coming when they had already acknowledged that they wanted to wait to see the Brexit results before they made a decision? Because they liked the market believing that they were going to raise rates, because it validates the phony recovery. It validates the narrative that they're trying to create, that they can actually raise them. This is really all they're doing. It's not raising rates. It's talking about raising rates. That's, everybody keeps saying that, well, the Fed doesn't have any more room to cut, because normally when there's a recession that starts, the Fed cuts rates. And since they never really raised them, they can't cut them. Well, what they did is talk about raising them. And so instead of raising rates, they spoke about raising them. And now the way they can cut rates is by speaking about not raising them or speaking about reducing them, because that's their new policy. It's all talking, because they can't actually do anything because we're that broke and we have that much debt So the new tightening is we talk about why we're going to raise rates, but we don't actually do it and completely destroy the economy. And then when the economy slips back into recession, now we can talk about not raising rates, and then we can talk about cutting rates. And those are actual cuts before they get to the real cut, right? So they can do a lot of things as far as adjusting their rhetoric before they actually cut rates, which they are ultimately going to do at some point. But by backtracking, they are already effectively cutting, because given how weak the economic data is, had the Fed successfully raised interest rates a few years ago to a higher level, they would already be cutting them, right? They would be cutting them right now, given all the economic things that are happening, what's happening in the markets. The Fed would be cutting rates, but it can't cut rates. So it's doing the next best thing. It's not talking about raising them anymore. It's softening its rhetoric, because that's all you've got, right? You never, Teddy Roosevelt was speak softly and carry a big stick. Well, the Fed is the opposite. It's speak loudly because you have no stick. And the last thing you want to admit is that you don't have a stick, because if people know you don't have a stick, then you're impotent. And there's no place where the Fed is more impotent than inflation. And in fact, Marty Feldstein wrote this op-ed in the Wall Street Journal. And basically, he somehow says that there's method to the Fed's madness, that maybe they know what they're doing, which of course they don't, and that what their goal is not to raise rates until inflation gets to 3%, not 2%, but 3%. Now, why 3%? Well, because then, according to Marty Feldstein, the Fed can actually raise rates to 3%, short-term rates, and still not have positive rates. Because the Fed doesn't really want higher rates, so it needs higher inflation first, and then it can raise nominal rates without actually raising real rates. But one of the problems I think that Feldstein doesn't seem to understand is that even if inflation is officially at 3%, right, and it's probably much higher than that anyway right now, but even when it gets to officially 3%, the Fed still can't raise rates to 3%, because the total value of the debt is so enormous that the debtors can't afford to make the higher payments even if there's more inflation. So the Fed can't do it. Plus, of course, how can they target 3% as if they can actually stop the inflation from rising beyond 3%, which they can't? Because in order to get inflation to go back down when it's running higher, you need to get in front of it. So if inflation is 3% and you just make interest rates 3%, that's not going to stop it. You need to go to 4 or 5%. You need to get out in front of it to bend that curve. And of course, that's an impossibility. But also, one of the other things that he's overlooking is, according to Feldstein, the Fed will not lose credibility at 3% inflation, because even though they have this 2% target, that it's not actually a ceiling. And so what he says the Fed can do, and I actually agree with him, because I think they're going to do this, because I've been saying this the whole time. What Feldstein said the Fed will do to preserve its credibility on allowing inflation to go to 3%, but not tightening, is the Fed will say, look, it wasn't a ceiling. 2% is kind of an average that we shoot for. And since we were below 2% for so many years, well, now we can be above 2% for several years, because it'll all average out, right? If you have 3 years of 1% inflation, and then you have 3 years of 3% inflation, well, that's 6 years at 2%, and that's our goal, right? So they think the Fed will get away with it. But remember, the reason that the Fed is able to get away with saying that we have a 2% inflation goal, it's to buy insurance supposedly against deflation, right? The reason that 1% inflation is supposedly bad is because it's so low that it might go negative, right? The Fed is trying to have a 2% inflation rate to create some distance between zero and where you are, because they don't want to slip, heavens forbid, into deflation where the consumer gets a break, where the cost of living actually goes down. Like, we don't want to let that happen. So we need to take out some insurance against the lower cost of living by making sure the cost of living increases by at least 2%. But if inflation is at 3%, you don't need that insurance, right? If you had 3 years of 1%, you never got deflation. So you dodged the bullet. And now if you got 3%, what's the justification for keeping it there? Just so it can average out to 2? It doesn't make any sense, because you avoided deflation when it stayed at 1%. And now that it's at 3%, you wouldn't want to keep it there. You've got a lot of room between 3% and 0. So the whole thing doesn't make sense. Because if the Fed admits that they want an average of 2%, then they have to also admit that it was never about deflation insurance. They actually want inflation. They don't care about trying to prevent deflation. They actually want inflation. They want to make sure there's inflation regardless of the boogeyman of deflation. But of course, they're not going to get away with this 3% nonsense because number one, it won't stay at 3% because it's going to get higher. And what's going to do it is going to be the crash of the dollar. And that hasn't happened yet. And so far, what's saving the dollar is the pound, right? And all of the uncertainty that was unleashed. And again, I said in an earlier podcast, Brexit is the catalyst. This is not what is causing everything. Right? This was a powder keg. This was a house of cards, literally, created by the central banks. And you had all kinds of leverage bets in this system. And they're all unraveling. That's what's going on right now because Brexit ended up being the pin that pricked that bubble. But the pin is not the problem. It's the bubble that was the problem. It didn't matter what the pin was. And if it was Brexit, okay. But under normal circumstances with healthy markets, it wouldn't even matter whether the UK was part of the EU or not. Who cares? I mean, maybe the British care, but it's not that big a deal. But what is a big deal is the speculative leverage bubble that is popping because people are starting to worry about the implications of Brexit on this big, gigantic bubble economy. And that is why you're seeing the most carnage in the banks, and you're seeing this huge flight to treasury bonds where the yields are collapsing. You know, the yield on the 10-year treasury was actually slightly higher today, but it got as low as 1.336. I mean, give me a break. 10 years? I mean, that's way below even the Fed's or the government's version of inflation. So you talk about huge negative yields. And of course, the strongest currency on the planet is the Japanese yen, which continues to rise every day. The only currency rising faster than the yen is gold, or silver now, rising even faster than gold. But that's not currency, that's money. The currencies are money substitutes. But apparently the best substitute for real money is the Japanese yen. But obviously, anybody who knows anything about Japan, clearly Japan is not the safe haven, right? But it is a big funding currency, and where you see the manifestation of the unraveling of these carry trades. And that is what the dollar is getting caught up in. That is what treasuries are getting caught up in. But when the dust settles and more people focus on the game changer, what the Fed has now admitted, right? The Fed is no longer tightening. The tightening cycle is over. It's done. It was one and done. I was 100% right on that. I said if the Fed raised interest rates, they would do it once and only once, and that would be the end of the tightening cycle, not the beginning, and that is exactly what happened. We are now at the easing cycle, and the earlier stage of the easing cycle is the talk, right? Before the Fed actually cuts rates, first they start talking about not raising them or raising them later in the future. And then eventually they talk about keeping them steady or then having a bias to cutting them or whatever. But the easing rhetoric has already begun. And that is what is being priced in the precious metals market. It's started priced in the mining stocks. And it's going to be priced in the currency markets. You know, even with the collapse in the pound and all the uncertainty, the dollar index is still only at 96. That is not strong. The dollar did not make new highs. The euro barely went down. Why didn't the euro get crushed based on this? Because that's how weak the dollar is. The dollar has already rallied for years based on a lie, based on a false understanding of the true state of the U.S. economy and the direction of Fed monetary policy, interest rates, quantitative easing, all that. And so the dollar rather really did not rally as a result of Brexit. And so the next thing that's going to happen is it's going to fall, and it's going to fall hard. And that is going to, really unravel this paradigm, because right now people are still in the dollar for trade. It's not a safe haven. Yeah, they want to explain it that way, but most of the people who are looking at what's happening in the financial markets have no idea what's going on. They're not making money. They're getting creamed. They're losing a bunch of money this year. This is, again, the worst year for professional investors in 18 years, maybe more. Hedge funds are blowing up left and right. Everybody is underperforming. And why?
because nothing that's happening makes sense to them. But everything that is happening makes sense to me because this is what I expected to happen, and it's only the beginning. The difference is that I expected it years ago. It just took longer than I thought to begin to unfold. The rest of the investment community never understood it, and they still don't. And they're only gradually starting to connect the dots. You know, the people who were making money in the U.S. stock market, and again, there hasn't been much money made in the broad stock market in the last couple of years, but people did make some money in 2013 and 2014, right? Based on this false belief in a strong dollar and a good U.S. economy. And people like me who properly understood that this was a bubble, that the Fed was bluffing, that it either had no intention or no ability to actually deliver on the rate hikes that it was promising, we were the ones that were losing money. But the people who were wrong were the ones that were making money. But they weren't making money because they were right. They were making money because they had the numbers. Because if you have almost everybody wrong, if everybody believes something that's wrong, and they invest their money based on that wrong belief, then the price of what they are buying is going to go up, right? Because it's all a numbers game. If you have everybody thinking one thing and they all invest based on that premise, then prices are going to be set based on that misinformation. That happens in every bubble. Think about all the dot-com stocks in 1998, 1999 that were priced at these ridiculous sky-high numbers. Why were they priced so high? Because all the people buying them believed that these companies, even though they didn't actually have any profits, would eventually have profits. People believed in the new paradigm, and so they bid up these stocks to reflect those beliefs. The beliefs were wrong, but it didn't stop the stock prices from going up because so many people held those beliefs. And maybe for a while, there were people who believed that the beliefs were wrong and they shorted the stocks. But as the stocks kept going up, because the number of people who believed the nonsense far outnumbered the people who didn't believe it, well, they got forced out of the market. The markets were irrational longer than they were solvent, and they covered their shorts. And so the people who were wrong were the people who were making money. The people who were right were the ones who were losing money, at least on paper. But eventually, the truth comes out. All the people who were wrong discover they were wrong. And then the market quickly replaces the asset, in which case, if it's a dot-com stock, it collapses, right? That's what's going on now. All the people who were betting on the U.S., betting on the Fed, betting on the recovery, betting that Bernanke was a hero and Janet Yellen was a genius, all the people who swallowed that line, who were betting on that line, were wrong. And now they're surrendering all the profits that they thought they made. And believe me, we are early. We are early in this process. So many people still don't get it. And the people like me who knew all along that the people who were making money on paper were wrong because they just didn't get it. They had mistaken a bubble for a recovery. They didn't understand the real nature of the problem. They never did, which is why they didn't see the 2008 financial crisis coming. And because they didn't see that one coming, they didn't understand the dynamics that created it. And so they didn't see that all those dynamics were not only still in play, but had been expanded by the Fed. So people like me who look back and knew how it was going to end, we were the ones that for several years were not making money or were losing money on paper because the value of the things we were buying was going down because not that many people were smart enough to buy those things because they were all dumb enough to chase all the other things. And so now, as the reality is coming clean, all the stocks and all the positions that I've been buying the last few years, they're skyrocketing. And the positions that other people were buying have collapsed or are going sideways. And again, this is just the beginning. Ultimately, the fundamentals are going to vindicate everybody who was right and who was early. And they're going to punish everybody who was wrong, but who temporarily made money simply because everybody else was wrong too. And there are strength in numbers. But the numbers, it's a two-way sword. Because once all those numbers who were wrong discover they were wrong, and now they want to correct that mistake. They want to reverse their positions, and they want to do it at the same time. Everybody wants to squeeze through a tiny little door all at the same time. You know, imagine when all the big investors who don't own any gold or don't own any gold stocks, when they finally decide they want to buy. You know, where are the prices going to be? What's going to happen with all the people who are piling into the dollar when suddenly they want to get out? And of course, the currencies that they're going to want to buy are not going to be these other gigantic currencies that have other problems, but the smaller economies, the sound economies, the true safe havens that are being overlooked because people are concentrating on the U.S., which they think is a safe haven, which is not safe at all. It's only safe because people perceive it to be safe, and they only perceive it to be safe because they're fools. They don't understand just how risky the safe haven currency actually is, but when those risks are perceived and everybody kind of comes to that conclusion, you're going to see a big unwind. Right now, again, Brexit has taken the headlines. People are worried about Europe. And so that, again, that distracts people's attention from what's going on in the United States. Now, we do get a big employment number coming out on Friday. And so here's the deal there. If we get a strong number, they're looking for 180,000 jobs. And who knows, you think these numbers could be heavily manipulated. I mean, we've had two really bad numbers in a row. If we got a third number, it would really be, 3 strikes and you're out. The dollar would tank. I think gold will be over 1,400 on Friday, maybe quite a bit over if we have a really weak jobs number. But even if we get a strong number, I think they're looking for 180,000 jobs. Of course, if it's strong, it'll just be superficially strong. We'll still have people leaving the labor force. We'll still be destroying full-time jobs and replacing them with part-time jobs. Younger people 55 and younger will still be leaving the workforce. All the jobs will be going to people 55 and over, right? Those trends aren't going to change. The baby boom is coming out of retirement because they're broke or they're delaying their retirement. And younger people are still not even entering the labor force, or they're losing their jobs and they're moving back in with their parents. Regardless of whether we create 180,000 payroll jobs or 20,000, those trends are still going to be there. And again, nobody cares. But if the headline number is actually strong, I don't even think it's going to matter. I don't even think that the dollar is going to catch a bid on that. I don't think it's going to hurt gold. I think gold goes up regardless of what the payroll number is on Friday, because I think the markets are now perceiving that these numbers don't matter, that the Fed is no longer looking for data to raise rates. They're looking for data to cut them. If they were going to raise rates, they'd have already done it. The time to do that is long past, and we'll see. If we get a strong number on Friday and gold rallies anyway, and the dollar tanks or sells off anyway, then that'll prove that thesis. But on the other hand, if the number is weak and we have 3 bad job numbers in a row, then I think people are now going to really start talking more about stimulus and the need for stimulus and a rate cut. And of course, they're also going to be talking about some kind of fiscal stimulus. The government needs to spend more money, right? That's the problem. And of course, that's what Paul Krugman is going to say. That's why it didn't work, right? That's why it wasn't because it was the wrong medicine. It just wasn't enough of it. And, they're going to believe that in Washington. They're going to believe that at the Fed, because to believe anything else would just tear their world apart, because then they would have to admit that they're wrong. And they never want to do that. And of course, since the real solutions involve less government, cutting government spending, right, and being the bearer of bad news to the people who are benefiting from that spending, since the right thing to do is take the punch bowl away from the drunken partygoers on Wall Street, nobody wants to do that. No one wants to admit that that's the real excuse. So being able to say, you know what, we just need more. We're doing the right thing. We just need more stimulus. We need more alcohol. We need a bigger party. And in fact, we're going to invite more people to the party who might have missed it, because just in case you didn't benefit from the last round of quantitative easing, you're going to benefit from this new round, because now we're going to have quantitative easing for the masses, for the people. Bernie Sanders style, right? We're going to have real make work, old-fashioned Keynesian pump priming. You remember those stimulus checks that George Bush sent out in the waning days of his administration? Well, you know what? I think some stimulus checks might be in the mail in time for the November elections to help put Hillary Clinton, who, by the way, I guess I totally forgot about that, but if you didn't see the press conference from the FBI, which if that didn't make you sick, right? Basically, you listen to his talk about Hillary Clinton and how she did all these bad things. I mean, she sent out top secret emails and classified emails from her personal cell phone and her personal server. And not only from the United States, but she utilized that cell phone and that server in foreign countries, that some of them that were hostile to the United States. I mean, she totally jeopardized national security. And who knows how many top secret emails, are now in the hands of enemies because of the recklessness of Hillary Clinton. And the guy is saying, yes, what she did was bad. This is bad stuff. She never should have done it. But then after listing all the bad things, and it proves that she lied, because before she went out and said, well, yes, I used it, but I never used any classified information. I never sent any classified emails. Well, that's a lie, right? She did. The FBI said, yeah, she did. She sent plenty of classified emails from her personal server, or personal cell phone and personal server. But first of all, forgetting about that, all those emails should have been done on a government server, so we'd have access to it. You get a freedom of information request. You know what the government is doing. I mean, they have to do that. I mean, if I did what Hillary Clinton did, I would be kicked out of the brokerage industry. I would be barred, right? Because we have rules. I have to send all my emails that go to clients have to go from my corporate account. I can't send an email to a customer from a personal account. Why? Because the regulators need to review all the correspondences. They don't have access to my personal email. So if I'm going to contact a customer, I can only do it from my official email account. So the regulators have access to it. And so my firm, theoretically, my own compliance officers, the compliance officers review all the emails. They have to make sure that there's no violations of rules. If I'm emailing clients from my personal account, they can't review it, right? So all of my brokers know that they can't email clients from their personal accounts. And if we catch them doing that, they could get fired. Well, what's the discipline for Hillary Clinton, Secretary of State? She's supposed to do all of her emails using her official account, and she's not doing that. What's the penalty? She should have to give back her salary. She shouldn't even be able to claim that she was a former Secretary of State. She should be retroactively fired and asked to refund her money at a minimum because she didn't do her job. And this is something the guy from the FBI said that, well, there's no evidence to suggest that she was deliberately doing anything wrong. Well, is she an idiot then? I mean, how could she not know that what she was doing was wrong? I mean, because if she really didn't know, then how can you say she's qualified to be the president of the United States? I mean, she's that dumb, right? Because I'm sure she was told, too, that you need to use your official accounts, especially when it comes to the top secret stuff, right? If she really is that dumb, should she be the commander-in-chief of the United States? Should she get a promotion, right, from her last job when she was incompetent and she was grossly negligent at a minimum? Should she now be promoted to president of the United States? I mean, this is ridiculous. But of course, the rule is not about did she know. It was, if you're still grossly negligent, you still did something wrong. I mean, at a minimum, it's some kind of a misdemeanor. I mean, although maybe it's a felony, I'm sure there have been government officials who have done less stuff than this who have been charged with crimes. But Hillary Clinton, I guess, is above the law because, the Obama Justice Department isn't going to try to indict or charge their nominee. Although, they might actually have a better shot at the White House. Although, I mean, look, most people think Hillary's a shoo-in. But, Joe Biden might even be a better, an easier victory. So maybe, maybe it wouldn't actually hurt the Democrats to indict Hillary and get her off the ticket because she does have a lot of problems. But apparently in the polls now, she's ahead of Trump. So maybe that's one of the reasons that they don't want to risk changing horses. But the whole thing is rigged. If you look at it, it should be a disgrace to show that these, some government individuals are above the law, that we're not a nation of laws, that we're a nation of men, and certain men and women can break the laws with impunity if you have the right connections. And I don't even believe that Hillary Clinton had no knowledge. She obviously is a smart enough woman to know that what she did was wrong, but she did it deliberately for a reason. What was the reason? Because she wanted to send communications that she didn't want people to know about. She didn't want the government to know about it. Why? Well, there's a whole lot of reasons, but probably there's a lot of stuff going on. There's a lot of influence peddling, a lot of stuff going on with the Clinton Foundation, with her husband, with the speeches that she's giving, with the deals that she's sponsoring. I mean, there's a lot of pay for play. There are a lot of kickbacks. There was a lot of shenanigans going on, and Hillary Clinton wanted to do it in secret. That's what she did. And then she got caught, and then she claims, oh, well, I didn't know. And then, of course, nothing happens to her. And who knows, there are obviously some things that got destroyed, some things that we're never going to see. I'm sure it's a lot worse than the FBI actually knows. Yet the FBI is trying to claim that no reasonable prosecutor would take this case. I think that's a bunch of BS. I think a lot of cases that are a lot flimsier than this one, with a lot less evidence, end up being prosecuted. And the reason this one is not being prosecuted is because her name is Hillary Rodham Clinton, and that's it. And of course, she's the Democratic nominee for president. And if she was this bad as the Secretary of State, if she was this corrupt, and she's this corrupt as a candidate, just imagine the level of corruption in a Clinton White House. Once she gets to the height of power, just imagine. I mean, up to this point, I think the most corrupt president was Lyndon Johnson. I bet that Hillary Clinton beats him. I bet as bad as Lyndon Johnson was, I bet she's worse. If you ever watch House of Cards, I mean, Frank Underwood, she's probably worse than Frank Underwood and Lyndon Johnson. And the reality is, she may be our next president. And, it might be very fitting, though, for this whole House of Cards to come collapsing on her watch. And maybe she could take the blame and all of her predecessors and the whole Democratic machine when this thing comes collapsing down, because I don't see there's any way that we can elect Hillary Clinton and this country goes for 4 years without a major implosion. And it's going to be pretty hard for her to blame it on George Bush when it follows 8 years of Barack Obama, and it happens on Hillary's watch.